the gold market has long been seen as the ultimate hedge against uncertainty, a timeless refuge for investors when paper assets crumble and confidence in governments wanes. Throughout history, gold has represented security, wealth preservation, and independence from political and financial manipulation. But what most investors fail to recognize is that gold's value isn't only shaped by fear and scarcity, it's driven by a complex interaction of psychological, monetary, and economic forces. When the balance of these forces tilts too far toward emotion rather than fundamentals, the market becomes fragile, and what once looked like a safe haven begins to show cracks beneath the surface. That's exactly where the gold market stands today, overexposed, overvalued, and over-dependent on collective sentiment rather than real economic support. Gold's enduring appeal comes from its ability to maintain value over time. Unlike fiat currencies that can be printed at will, gold's supply is naturally constrained. This gives it a perceived advantage, especially during periods of inflation or geopolitical tension. However, markets are not governed by perception alone. They are governed by the flow of capital, the balance of demand and supply, and the psychological cycles that investors collectively move through. When investors begin to pour into gold, not because the data supports it, but because everyone else is doing so, that herd behavior lays the foundation for instability. The current gold rally, which many see as a signal of protection, is in many ways a mirror of speculative manias from the past, moments when people traded logic for emotion and preparation for panic. To understand why the gold market is becoming fragile, we have to separate the short-term dynamics from the long-term narrative. In the long term, gold will always have a place in a diversified portfolio as a store of value. But in the short term, its price can become detached from reality. Over the last several quarters, gold prices have surged on the back of fear-driven narratives, global inflation, political conflict, rising debt, and uncertainty about currencies. Yet, few are questioning whether those fears are being priced rationally. Every investor rushing into gold today believes they are escaping risk, but in truth, many are running straight into a different kind of risk, market concentration, and emotional overconfidence. What happens in these situations is predictable when you study market behavior over centuries. As prices climb, optimism builds. Investors start to believe that the trend is unstoppable. Media coverage amplifies the momentum, reinforcing the illusion that gold is not just a store of value, but a guaranteed win. The problem is, nothing in markets is guaranteed. Every asset class has a limit to how far it can stretch beyond its intrinsic value before it snaps back. When everyone believes in a single narrative that gold can only go up, that narrative becomes dangerous because it blinds people to the risks forming underneath. We saw similar patterns in the late 1970s when inflation panic drove gold to record highs before a brutal correction wiped out a generation of overconfident investors. We saw it again in 2011 when fears of global financial collapse sent gold soaring above 1,900 per ounce, only to fall sharply once those fears eased. Each time the story was the same, a cycle of human emotion, optimism, greed, overconfidence, and finally fear. Gold doesn't change, human behavior does. The market's strength and weakness lie not in the metal itself, but in the psychology of those who trade it. The present gold market exhibits all the classic signs of a late-stage emotional rally. The volume of speculative positions in gold futures has increased significantly, indicating that traders are no longer buying for long-term preservation, but for short-term profit. Exchange-traded funds backed by gold are attracting capital at a pace disconnected from underlying fundamentals. Central banks, while still holding reserves, are not increasing purchases at the same rate as they did during previous crises, signaling that institutional demand may not justify current prices. At the same time, liquidity in other asset classes is tightening, and when liquidity tightens, investors often sell their most liquid holdings first to cover losses elsewhere. Gold, ironically, can become the victim of its own success in such moments. Another layer of fragility lies in the misconception that gold is immune to macroeconomic shifts. Many retail investors assume that inflation automatically drives gold higher, but this relationship is not absolute. Gold tends to rise when real interest rates are negative, meaning when inflation is high and yields are low. However, if central banks raise rates faster than inflation, real yields turn positive and gold typically suffers. This is precisely the scenario forming now. As economies stabilize and monetary tightening continues, the supportive environment for gold is eroding. Investors who bought at inflated prices, expecting endless inflation, may soon face forced selling as returns stagnate and liquidity dries up. The deeper issue isn't that gold is losing its role, it's that people are misunderstanding its role. Gold is not a short-term instrument to beat inflation or profit quickly from crisis. It's a balancing asset, one designed to offset long-term systemic risks. When investors treat it as a speculative vehicle rather than a strategic one, they distort its market function. In doing so, they create instability not only for themselves but for the entire ecosystem surrounding gold, miners, ETFs, and derivative markets included. This is how emotional investing transforms a hedge into a hazard. One must also consider how the structure of today's financial markets amplifies fragility. In the digital age, information moves instantly and sentiment shifts with the speed of a tweet. When fear or euphoria spreads through social media or financial headlines, the reaction can be immediate and exaggerated. Leverage magnifies this effect. A 2% decline in gold prices can trigger margin calls and automated sell-offs, creating cascading declines that far exceed what fundamentals justify. This is not new. It's the same dynamic we've seen in every major correction, only faster and more synchronized because technology amplifies human psychology. In essence, the gold market's current vulnerability is not due to gold itself, but due to the collective behavior of investors who have lost touch with the underlying economic reality. They are buying based on emotion, not analysis. They are trusting the crowd, not the data. And they are assuming safety in numbers, which is often the most dangerous assumption of all in finance. The irony is that many of these investors believe they are acting conservatively by holding gold, but in fact, they are speculating just as aggressively as those chasing technology stocks or cryptocurrencies. The educational lesson here is timeless. Every market, no matter how ancient or revered, is susceptible to human error when emotion overrides logic. True investors must learn to distinguish between perception and reality, between narrative and numbers. Gold remains an important component of global wealth, but its short-term price is not immune to correction. Understanding that distinction is the difference between preserving wealth and losing it. The gold market, therefore, is standing at a critical juncture, one defined not by the metal's scarcity or beauty, but by the fragility of the human behavior surrounding it. If investors continue to pour in blindly, driven by fear and headlines, they will create the very collapse they fear. The wise will step back, study the mechanics, and prepare. Because markets, like everything else in the economy, are not ruled by emotion, they are ruled by cause and effect. Those who understand that will endure. Those who ignore it will learn the hard way. The potential collapse of the gold market is not about gold losing its intrinsic value. It's about the structure the structure supporting its current price becoming unsustainable. Every market functions on a foundation of liquidity, leverage, and sentiment, and when those three elements become unbalanced, a correction becomes inevitable. In gold's case, what we're seeing now is a buildup of speculative positions, excessive reliance on emotional narratives, and a collective misunderstanding of the broader economic forces at play. These forces, interest rates, debt cycles, currency strength, and geopolitical risk, interact in predictable ways. Yet investors often ignore these causes and affect relationships in favor of short-term reactions. The issue is not gold itself, but how people are treating gold not as a strategic hedge, but as a one-way bet. Gold's value has always been symbolic, a reflection of trust and fear in the financial system. But symbols can be distorted. In periods of uncertainty, investors tend to cluster around gold as if it were immune to the dynamics of modern economics. They forget that even gold, for all its history and stability, is still subject to cycles of demand, liquidity, and speculation. Over time, this misunderstanding becomes dangerous because it detaches price from fundamentals. The higher prices climb on emotion alone. The more vulnerable the market becomes to a shock, a shift in sentiment, a change in monetary policy, or a tightening of liquidity. That's what creates collapses, not the disappearance of value, but the evaporation of belief. If you examine the mechanisms beneath the surface, you'll see how the foundation of this current gold rally is weakening. Over the last several quarters, gold prices have surged largely due to fears of inflation and global instability. Investors bought aggressively, assuming central banks would lose control of monetary policy. But what happens when those assumptions shift? Inflation, while still elevated, has shown signs of moderation. Major central banks, led by the U.S. Federal Reserve, are gradually restoring real interest rates. As real yields rise, the incentive to hold non-yielding assets like gold decreases. This change in relative attractiveness doesn't destroy gold's long-term purpose, but it undermines the speculative premiums currently baked into its price. Leverage is another silent threat. Much of the trading in gold today isn't about the physical metal sitting in vaults. It's about paper representations. Futures contracts, ETFs, and other financial instruments. These products allow investors to control large positions with relatively small capital commitments. In good times, leverage amplifies gains, but in downturns, it magnifies losses. When gold prices start to fall even slightly, leveraged investors are forced to sell to meet margin calls, accelerating the decline. This creates a feedback loop. Falling prices trigger more selling, which drives prices down further, fueling panic and liquidity shortages. It's not gold that collapses. It's the leverage structure around it that implodes. This dynamic has played out countless times in history. The late 1970s saw gold prices skyrocket amid runaway inflation, only to crash once central banks tightened monetary policy. In 2011, similar conditions reappeared. Sovereign debt fears and quantitative easing pushed gold above $900 per ounce. But when global stability improved, prices tumbled by nearly 40%. Each of these episodes followed the same pattern: misinterpretation of macroeconomic signals, excessive leverage, and misplaced confidence. Investors mistook short-term fear for long-term fundamentals, failing to see that markets are adaptive systems that constantly rebalance themselves. To understand why a collapse might occur before November, we must look at how liquidity is evolving across global markets. Liquidity, the availability of money and credit, is the oxygen that fuels all asset prices. When central banks tighten, liquidity contracts and the air becomes thinner. Assets that depend on easy money begin to suffocate. Gold, despite its reputation as a store of value, thrives in environments where real yields are low and money is abundant. But we are entering a phase where liquidity is being deliberately withdrawn to combat inflation. This creates downward pressure not just on gold but across commodities. Those who bought gold under the illusion that printing money will never stop will soon realize that liquidity cycles are not linear. They ebb and flow. And when the tide goes out, the overexposed positions are revealed. There's also a psychological dimension to this dynamic. Many investors see gold as the antidote to financial instability, a way to escape the uncertainty of fiat currencies. However, this belief often turns into a form of confirmation bias. They interpret every negative headline, a war, a debt crisis, a political dispute as justification to buy more gold, reinforcing the very bubble they fear. But when the data begins to contradict their narrative, they're slow to react. This delay creates what economists call lagged behavior, where investors hold on to losing positions longer than they should, waiting for their beliefs to be validated again. When validation never comes, they all exit at once. That's how collapses happen. Another important factor is the role of central banks themselves. For years, central banks have been steady buyers of gold as part of their reserve diversification strategy. However, this demand is often misinterpreted by retail investors as a signal of endless institutional support. The reality is more nuanced. Central banks buy gold for long-term strategic reasons, not for short-term price speculation. Their purchases can stabilize the market over decades, but they cannot prevent cyclical corrections. If central banks slow their purchases, even temporarily, it sends a powerful signal that demand is cooling, prompting traders and speculators to reassess their positions. The misunderstanding of macroeconomic cause and effect relationships is the real issue here. Many investors think in isolation. They see rising debt and assume inflation must continue. They see political tension and assume risk will drive gold higher. But the global economy doesn't operate in simple one-directional logic. Higher debt can, under certain circumstances, suppress inflation if it leads to slower growth. Political instability doesn't always translate into gold gains if it triggers liquidity shortages or dollar strength. Gold prices move in relation to the broader ecosystem. Interest rates, growth expectations, trade balances, and capital flows. Those who fail to understand this interconnectivity often find themselves caught on the wrong side of the trade. What makes the situation particularly precarious now is that investors are not just over-leveraged financially, they're over-leveraged emotionally. They've tied their sense of security to an asset they believe cannot fail. That emotional dependence creates rigidity, and rigid systems break more easily. The wisest investors, those who survive market corrections, are flexible. They diversify, rebalance, and question their assumptions regularly. They understand that gold's role is not to guarantee profits, but to balance risk in an uncertain world. When investors abandon that principle and chase gold as a source of return rather than protection, they distort its purpose and expose themselves to unnecessary volatility. Ultimately, the expected collapse in the gold market before November is not a prediction of doom, but a reflection of cause and effect. Markets don't punish value, they punish imbalance. The imbalance today lies in the collective overconfidence that gold can only move upward. But the same macroeconomic forces that push gold up are now reversing tighter money, rising real yields, and reduced liquidity. When the market adjusts, prices will fall sharply, shaking out the weak hands who mistook emotion for insight. This correction will serve as a reminder that no asset, not even gold, can defy economic gravity forever. The collapse will not destroy gold's place in the financial system. It will restore balance to it. Those who understand that this is a liquidity and leverage issue, not a value issue, will remain calm and prepared. Those who don't will view it as a catastrophe. But as history has shown time and again, what feels like collapse is often just the market's way of reestablishing equilibrium. In that sense, the gold market's coming correction is not an end. It's an education. Central bank policies, global debt imbalances, and geopolitical pressures are converging in a way that creates one of the most dangerous setups for the gold market in years. These three forces are interconnected, and when they move together in the wrong direction, they create instability that ripples through every asset class, including gold. Most investors tend to look at each of these elements in isolation: central banks raising or cutting interest rates, governments accumulating debt, or global tensions rising. But the reality is that the global financial system is an ecosystem. When one part shifts, it affects all the others. The problem today is that these forces are not moving toward balance. They are reinforcing each other's weaknesses, amplifying risk across the system. Those who fail to understand how these mechanisms interact will be blindsided when the market adjusts. Central banks play a defining role in shaping global capital flows and asset valuations. Their decisions about money, supply, interest rates, and liquidity determine the environment in which investors operate. Over the past several years, central banks have moved from an era of loose monetary policy, where money was abundant and interest rates were near zero, to an era of tightening. That shift is not just a policy change, it's a paradigm shift. During the years of easy money, gold thrived because the cost of holding a non-yielding asset was low, and investors feared currency debasement. But as central banks now withdraw liquidity to control inflation, real interest rates are rising. When real yields rise, gold's appeal diminishes. This is not a matter of sentiment. It's a matter of mathematics. The opportunity cost of holding gold increases when investors can earn returns elsewhere, particularly in government bonds and money markets. However, the tightening of monetary policy doesn't happen in a vacuum. It interacts with the global debt burden, which has reached historically unprecedented levels. Governments, corporations, and households have accumulated trillions in debt during the low interest era. That debt now needs to be refinanced in a higher rate environment. The result is stress, not only on balance sheets, but also on growth expectations. Slower growth, combined with higher financing costs, leads to fiscal strain. For investors, this creates confusion. On one hand, they see rising risks that should theoretically support gold. On the other hand, they see tightening liquidity that reduces the ability to buy and hold it. This paradox is what creates volatility. Gold is being pulled in opposite directions by macroeconomic gravity. One force trying to lift it through fear, another pushing it down through tightening liquidity. Global debt is the silent killer in this equation. When debt levels become too high, policymakers face a dilemma. They can either raise interest rates to control inflation, risking defaults and recessions, or they can keep rates low to ease the debt burden, risking further inflation. Either path leads to instability. Historically, gold benefits when the system leans toward inflation and currency weakness. But when policymakers lean toward austerity and higher real yields, gold suffers. What makes the current situation particularly complex is that different regions are moving in different directions. While some central banks are still fighting inflation, others are trying to stimulate weak economies. This policy divergence creates unpredictable capital flows, which in turn create erratic movements in gold prices. The world's monetary map is fractured, and in that fragmentation lies enormous risk for those who assume gold will behave predictably. The third major force, geopolitical pressure, adds a layer of uncertainty that magnifies these economic risks. Geopolitics influences markets not only through fear but through actual disruption of trade, energy, and currency systems. Conflicts between major powers, supply chain breakdowns, and sanctions create ripple effects that reshape global capital allocation. Traditionally, gold rallies during geopolitical crises because investors seek safety. But what's happening now is more nuanced. Geopolitical fragmentation is not just creating short-term fear, it's creating structural shifts in the global order. The world is moving toward multipolarity, with competing blocks of influence, currencies, and trade routes. While this transition increases uncertainty, it also forces countries to diversify their reserves and reallocate capital. Paradoxically, as nations buy more gold for reserves, individual investors may face declining liquidity as prices become distorted by institutional hoarding and uneven demand. When these three forces, central bank policy, global debt, and geopolitics, converge, the system becomes fragile. Each one individually can be managed, but together they form a feedback loop. Central banks raise rates to fight inflation, which worsens debt burdens. Rising debt stress slows economies, which triggers more geopolitical tension as nations compete for resources and influence. That tension, in turn, pressures central banks to intervene again, either by loosening policy or stabilizing currencies. This cycle creates confusion and volatility across all assets, including gold. Investors who interpret these forces simplistically, expecting gold to always rise when the world is unstable, fail to see the bigger picture. The reality is that when liquidity dries up, even safe assets are sold to cover losses elsewhere. Gold is not immune to the liquidity squeeze. It becomes a source of cash when markets panic. This is why understanding the interconnectedness of macroeconomic systems is crucial. When liquidity tightens globally, everything becomes correlated. Gold, stocks, bonds, and commodities begin moving together rather than offsetting each other. This correlation breakdown surprises investors who assume gold will always provide diversification. But in reality, during extreme liquidity events, everything that can be sold will be sold. The smart investor recognizes this pattern and prepares not by predicting every move, but by ensuring that their portfolio can survive these systemic shocks. We're now seeing early warning signs of this convergence. Central banks are signaling more cautious stances, debt costs are escalating, and geopolitical alliances are fracturing. The global economy is entering what can be called transition phase, moving from abundance to constraint, from cooperation to competition. In such periods, capital reallocates violently. Gold will not be exempt from this. It may initially surge as fear rises, but as the liquidity squeeze deepens, forced selling could cause a rapid and painful correction. It's not about whether gold is valuable. It's about whether investors can afford to hold it when cash becomes scarce. For the typical investor, the lesson here is not to abandon gold, but to understand the context in which it operates. Gold's role is long-term protection, not short-term speculation. Its strength lies in stability, not momentum. To treat gold as an indestructible asset is to misunderstand the forces shaping the economy. Central banks can change direction overnight. Debt markets can reprice within weeks. Geopolitical events can alter trade flows in days. A prudent investor must think in probabilities, not certainties. The belief that gold will continue rising indefinitely simply because the world is unstable ignores the fundamental truth that markets adapt. The interaction of these three macro forces is creating an environment of illusion, where surface level trends disguise deeper fragilities. Gold may look strong, but underneath, the support system is cracking. The liquidity that drove its ascent is being withdrawn. The fear that fueled demand is becoming complacency. The debt that sustained global growth is turning into a drag. And the geopolitics that once provided narrative support is now creating real economic fragmentation. These shifts are not hypothetical. They are visible in capital flows, currency movements, and trade patterns. When the adjustment comes, it will not be gradual. It will be sudden because the build-up of imbalances takes time, but the resolution happens quickly. Investors who understand the cause and effect chain will not be surprised. They will see the signs and prepare. Those who rely only on emotion or historical assumptions will be caught off guard. The collapse of the gold market before November, therefore, should not be seen as a random event. It is the logical outcome of an interconnected global system under stress, one where central banks, debt dynamics, and geopolitical shifts are colliding at the same time. Understanding this is not about predicting disaster, it's about recognizing cycles. Every great economic shift follows this same rhythm: excess tightening, correction, and adaptation. Gold will continue to play a vital role in the global economy, but its short-term trajectory is dictated by forces far beyond its own supply and demand. Those who study these forces, rather than reacting emotionally, will not only protect their wealth, but position themselves for opportunity when the correction ends. Because in the end, markets do not punish knowledge. They punish ignorance. Understanding how to navigate collapsing markets isn't about reacting to headlines. It's about developing a framework, a deep understanding of how things work. The wisest investors aren't those who predict what will happen tomorrow, but those who understand why things happen and how to position themselves no matter what unfolds. This mindset is the foundation of lasting success in investing. When I talk about preparing intelligently, I mean cultivating a balanced perspective that allows you to see risks and opportunities clearly rather than emotionally. Most people lose money not because they lack intelligence, but because they let emotions override logic when the environment shifts. The key is to think in terms of cause and effect. Every economic event, whether it's inflation, asset bubbles, currency depreciation, or market crashes, is the result of relationships among forces like productivity, debt, interest rates, and psychology. If you understand these forces, you can anticipate outcomes without needing to guess the future. Take the example of gold. When liquidity expands, meaning central banks are printing money and real interest rates are negative, gold typically rises because it offers protection against currency debasement. But when liquidity contracts and real rates rise, capital tends to flow back into yield-bearing assets, pulling money away from gold. That's not speculation, that's cause and effect. The problem arises when investors treat markets as if they exist in isolation. They buy gold because they fear inflation, but don't account for the fact that inflation itself can trigger policy responses that undermine gold's appeal. The cycle turns and they're caught off guard. Understanding how one part of the system affects another is what separates professionals from amateurs. When you grasp that everything in the economy is connected, that one variable moves because another has shifted, you stop making emotional decisions. The next step is diversification. People often misunderstand diversification as merely holding different assets. True diversification is holding uncorrelated assets, meaning assets that perform differently under the same conditions. For example, gold, stocks, bonds, and real estate all behave differently depending on the economic cycle. When one falls, another may rise. The mistake most people make is concentrating too heavily on what's currently performing well, believing it will continue forever. but cycles always reverse. That's why balance is key. It's not about maximizing short-term returns. It's about minimizing long-term risk. In my research and practical experience, I've found that having a balanced portfolio, what I call the all-weather portfolio, is one of the most powerful ways to protect yourself from market turbulence. It's built on the idea that you don't know what the future will hold, but you can prepare for all environments, inflationary, deflationary, growth, and contraction. The idea is simple. Instead of betting on one outcome, you position yourself so that no single outcome can destroy you. This isn't exciting to those chasing quick profits, but it's how wealth survives and compounds across generations. Another critical aspect of preparation is understanding that risk cannot be eliminated. It can only be managed. Most investors don't truly measure risk, they measure returns. But return without context means nothing. Two investors might earn the same percentage gain, but if one took 10 times the risk, they're in a far weaker position. That's why the best investors focus more on downside protection than on upside potential. If you lose 50%, you need 100% gain just to recover. That's math, not opinion. So the first rule of survival is simple: don't lose big. Risk management also means knowing your own psychology. In every market downturn, emotions amplify. Fear makes people sell at the bottom. Greed makes them buy at the top. It's human nature. The only antidote is structure, pre-defined rules for how you invest and rebalance, not based on feelings but on logic. That's why I emphasize principles over predictions. When you operate by principles, you remove impulsiveness from your decisions. You can't control the markets, but you can control your behavior, and that's where your real power lies. The coming months, particularly in uncertain environments like this one, will test the discipline of investors. The temptation to chase performance or panic sell will be high. Those who lack understanding will react to every movement, every rumor, every headline. But those who think in systems, who understand the interplay of debt cycles, policy responses, and human behavior, will stay grounded. They'll recognize that volatility is not necessarily danger. Sometimes it's opportunity. Let's put this in practical terms. If gold collapses before November, as the signs suggest, the unprepared investor will see disaster. But the prepared investor will see it as a natural correction, a chance to accumulate quality assets at fair prices. The difference between the two isn't luck, it's perspective. The unprepared investor focuses on short-term outcomes. The prepared one focuses on long-term positioning. Preparation also involves scenario thinking, asking, what if? What if inflation falls faster than expected? What if central banks change course? What if geopolitical risks ease or worsen? You don't have to predict which scenario will occur. You just need to make sure you won't be ruined if any of them do. That's what intelligent preparation means, constructing your strategy so that no single event can destroy your portfolio. Finally, remember that the economy, like nature, moves in cycles. Periods of prosperity are followed by periods of correction, not because the system is broken, but because imbalances need to be reset. Those who understand this don't fight cycles, they adapt to them. They build resilience. They prepare during good times for what they know will inevitably follow. So when I talk about balancing risk exposure and diversifying intelligently, I'm not just talking about portfolio strategy. I'm talking about mindset. It's about humility, acknowledging that you don't know the future, but you can prepare for it. It's about discipline, sticking to principles when others are driven by emotion. And it's about perspective, realizing that losses and downturns are part of a larger cycle of opportunity and renewal. The investors who thrive in turbulent times are those who approach markets as students of cause and effect, not gamblers chasing trends. They recognize that success in investing isn't about brilliance in the moment, but consistency over decades. That's what I mean when I say the wisest investors prepare intelligently. They don't react to events. They understand them. They don't panic when markets shift. They anticipate those shifts as part of a natural cycle. And most importantly, they remember that true wealth isn't built by avoiding risk, but by managing it with knowledge, balance, and discipline. In conclusion, the message behind this warning isn't about fear. It's about awareness. The potential collapse of the gold market before November is not a random event or a sign of the world ending. It's a reflection of deeper, recurring economic principles at work. Throughout history, every boom has been followed by a correction, and every correction has laid the foundation for the next phase of opportunity. The investors who survive and even thrive are those who learn to see these patterns clearly instead of reacting emotionally to them. Gold has always been a symbol of security, but no asset is immune to the forces of human behavior, liquidity shifts, and policy decisions. When people rush into any investment out of fear, they create instability. When they assume safety is guaranteed, they unknowingly create danger. What we're witnessing in the gold market is not a destruction of value, but an adjustment, a rebalancing between reality and emotion. And that's something every serious investor must learn to anticipate. This moment is a test of understanding. It separates those who chase trends from those who study cycles, those who gamble on timing from those who build systems that endure. The real challenge isn't predicting whether gold will fall. It's understanding why it might fall and how that connects to the larger picture of debt, interest rates, and global liquidity. Once you grasp that, you move from being reactive to being strategic. The most powerful investors don't bet on certainty. They build portfolios that can survive uncertainty. They diversify intelligently, manage risk consistently, and think in probabilities rather than emotions. They recognize that pain in the short term often leads to gain in the long term. If you stay disciplined, balanced, and humble enough to learn from every cycle. So, as we approach this potential market shift, remember, success in investing isn't about knowing what happens next. It's about being prepared for whatever happens next. Those who understand how the system works will use this correction to strengthen their position. Those who don't will get swept away by it. The difference between the two is education, perspective, and discipline. In the end, the collapse of the gold market, if and when it comes, won't be a tragedy. It will be a lesson. A reminder that markets, like life, move in cycles. A reminder that balance and understanding are far more valuable than prediction and panic. And most importantly, a reminder that the path to lasting wealth is not built through reacting to fear, but through mastering the timeless principles that govern how economies and markets truly work.